In the Almanac of American Philanthropy, Carl Zinsmeister points out that Americans, especially affluent Americans, are some of the most charitable people in the world. Now, chances are that you use some of your wealth to help support your favorite causes or organizations that are most important to you. But unfortunately for a lot of you, your contributions, well, they may not be having as big an impact as they could be. And you could be missing out on some valuable charitable tax benefits that may help both you and your favorite charities. So in this video, we're going to size up the effectiveness of your giving, along with some strategies that could potentially put some real power behind your philanthropy. AES Nation, an American company that's devoted to accelerating entrepreneurial success, did a study in 2018 where they surveyed 204 affluent individuals, people with investable assets of at least $500,000 or more. And they found that nearly 3/4 of them said that they're making significant charitable contributions every year. But they also found that a little over 3/4 of them were not using any tax-efficient strategies as part of their giving. They also asked this same group if they were interested in learning about tax-efficient charitable giving strategies, and they got back an overwhelming 90% yes to that question. So the good news here is that there is a strong interest among affluent Americans to learn more about ways to give more strategically and more tax efficiently. The reason, I believe, for this gap between the interest in using tax-efficient strategies and the actual use of such strategies is that affluent donors just aren't educated enough about alternative ways to give. So what we're talking about here with tax-wise charitable planning is the process of making a significant charitable gift, either during a person's lifetime or perhaps upon their death, that is part of a financial plan or an estate plan, and doing so as tax efficiently as possible. Now, we've learned here at North Star Financial Planners that tax-wise charitable planning is usually best accomplished as part of an overall wealth plan that addresses other key issues like wealth transfer and wealth protection and cash flow needs. So when affluent donors can take into account the various assets that they have and how they're structured, there is the potential there to make some pretty meaningful charitable gifts that also provide meaningful tax benefits to the donor. And we found that proactive wealth planning that takes into account an affluent donor's broader financial situation can lead to much better outcomes than what I would call checkbook philanthropy, in which charitable gifts are made out of cash flow. But I do want to point out something here that's critical. Successful tax-wise charitable planning starts with a person's philanthropic agenda and their desire to do good for their favorite charities. And then it focuses on how to be as tax efficient as possible. It's that donors' intent to achieve charitable goals that is most important in this whole process. So, what are some of the tax-wise strategies beyond just simply writing checks that tax-efficient givers use? Well, 3 of the most commonly used approaches are charitable trusts, donor-advised funds, and private foundations. So, let's talk about charitable trusts for a minute. There are different types of charitable trusts that have different tax benefits and other benefits for the donor as well as the charities. But they're often used as part of a comprehensive wealth plan, especially as part of an estate plan, because they can effectively mitigate various taxes and move assets from one generation to another. So for those that are philanthropically motivated, a charitable trust can be a pretty effective way to eliminate certain taxes like capital gains on the sale of a privately held company or some other highly appreciated asset. Now, as I mentioned, there are a few different types of charitable trusts. For example, one type starts with the individual putting appreciated assets into the trust. The trust then sells those assets without incurring any income or capital gains taxes and invests the proceeds and then pays one or more beneficiaries an income stream for the rest of their life, or maybe just a set number of years. After that time period or the death of the last beneficiary, the assets that still remain in the charitable trust are distributed to the designated charity or charities. This type of charitable trust offers a few potential benefits. First, it converts an appreciated asset into a lifetime income stream without having to pay capital gains taxes on the sale of the asset. Second, the donor receives a partial income tax deduction on the value of the asset. And third, the donor, or another named beneficiary, receives an income stream for their life, or a set number of years. Another common tax-wise charitable planning strategy is using donor-advised funds. A donor-advised fund is typically set up by a financial services firm, like a mutual fund company, or a community foundation, or maybe a charitable group. And they, in turn, manage the fund's day-to-day operations. Now, donors make irrevocable contributions to the donor-advised fund, and those assets are invested and they grow tax-free over time. Donors can then recommend which charities they want to receive their financial contributions, and the donor-advised fund makes the grants. And the third tax-wise strategy we'll talk about is the use of private foundations. Now, a private foundation is a nonprofit organization that is funded primarily by a person or a family or maybe even a corporation. The assets in the private foundation, which are called the endowment, are regularly invested to produce income that's used to make grants to other charities as well as to support the operations of the private foundation itself. So let's compare for a minute private foundations and donor-advised funds, two of the options more commonly used by philanthropically motivated folks. And let's compare on key characteristics such as control and expenses and how much family involvement there is, as well as how well they do at creating legacy. First, when we compare how much control a donor has, in a private foundation, the donor has complete control, where this just isn't the case with a donor-advised fund. A donor-advised fund technically allows the donor to only recommend which organizations ultimately receive the money. Well, that said, donor-advised funds do almost in all cases honor the recommendations of the donor, as long as the recipient organization is a registered charity, of course. And when we look at how the assets are managed, with a donor-advised fund, the assets are managed by the firm that's entrusted with the money, whether it's a mutual fund company, as we mentioned, or a community foundation. But with a private foundation, it's the donor, or his or her advisors, that manages the assets. Now, from a cost perspective, a private foundation is going to cost more. It'll be more expensive to set up and manage than a donor-advised fund would be. But one of the biggest differences between the two is the succession possibilities. With a private foundation, the succession possibilities are basically unlimited. This allows for a family to exercise control and instill the importance of philanthropy across potentially many generations. In contrast, most donor-advised funds have limits on succession. Now, in situations where such limits might be reached, the assets that are remaining in the donor-advised fund go into a general pool at the fund company, community foundation, or whatever entity is managing those assets. So making tax-wise charitable planning an integral part of your wealth planning efforts can be very beneficial. But again, as a reminder, it's really essential here that the tail isn't wagging the dog. The core of tax-wise charitable planning needs to be your desire to have an impact on one or more charities. Focusing only, or for that matter even too much, on just the tax mitigation can end up leading to really substandard results. Unfortunately, our experience has been that too many professionals push the tax benefits of the charitable giving without really focusing much on the importance of the charitable intent. But for those who do want to make a difference, charitable strategies such as trusts or private foundations and donor-advised funds can be a very powerful wealth management solution and are some of the best ways to do well by doing good. So take some time to think about your own charitable intentions and your goals, both what they are today and what you think they might look like down the road. With that information, you can start to explore and assess your best strategies for achieving tax-efficient philanthropy. An elite wealth manager could be valuable in helping you think through these and related wealth and charitable planning concerns. We'd love to talk to you about it here at North Star Financial Planners, and you should consult with your tax professional as well to discuss your charitable goals and how you might achieve them in the most tax-efficient way. Thanks for watching.